Hey everyone, welcome back to Corporate Decoder, the place where we unpack the hidden stories inside corporate filings. And today we've got a juicy semi-annual report that is basically a financial treasure map, if you know where to look. Alright, let's dive into the Aspiriant Trust's latest financial snapshot for the period ending the 30th of September 2025. We're talking about 4 different funds here. And like any good financial detective, we're going to zero in on what truly matters. First up, the Aspiriant Risk Managed Taxable Bond Fund. This fund is sitting pretty with over $316 million in net assets. That is a lot of money, and usually a good sign of investor confidence. Now listen to this, their portfolio turnover rate is 0%. That is practically motionless. It's like they bought it and forgot about it. While this could mean a stable, patient strategy, it also means they aren't actively trying to capitalize on market swings. The biggest chunk of their holdings, a whopping 30.4%, is in the Vanguard Total Bond Market Index Fund. This is a pretty standard diversified holding for a bond fund, suggesting they are playing it safe and following the broad market. Next up, the PIMCO Income Fund, making up another 15.7%. These aren't exactly exciting dynamic plays, but they are solid established players in the bond market. Now let's shift gears to the Aspiriant Risk Managed Municipal Bond Fund. This one's a beast, managing over $1.1 billion. That is a huge amount of capital. They've got almost $1.2 billion in net assets. Compare that to the taxable bond fund, and you see where the real money flows for municipal bonds. Their portfolio turnover rate is 12%. So they are moving a little more than the taxable bond fund, but still not exactly making big, aggressive bets. Their top holding here is the Mackay Municipal Opportunities Fund at 8.5%. This is a significant chunk, and it suggests a focus on specific municipal opportunities rather than just broad diversification. Following that is the iShares National Muni Bond ETF at 6%. Again, a pretty standard holding, but the top 2 combined give us a clue about their strategy. Now this is interesting, we see a note here defining a defaulted security. It means the issuer has failed to pay its debts. Seeing this definition in the footnotes of a municipal bond fund report is a red flag. It implies they might be holding some of these risky assets. And it is crucial to understand how much exposure they have to such issues. Moving on to the Aspiriant Defensive Allocation Fund. This one's a bit of a different beast, with over $1 billion in net assets as well. Over $1 billion here, showing it is a significant part of their offering. And get this, their portfolio turnover rate is 0%, just like the taxable bond fund. This is really emphasizing a long-term hands-off approach. Their number 1 holding is the GMO Benchmark, free allocation fund at a massive 25.8%. This is a huge concentration in one underlying fund, which is a major risk if that fund underperforms. Then we have the Wilshire Bridgewater Managed Alpha Fund at 14.1%, also domiciled in Ireland. Again, significant concentration in specific funds, especially alternative strategies, which can be less predictable. Interestingly, for this fund, liabilities actually exceed assets by a tiny fraction. This isn't usually a big deal for funds, as it can be a temporary accounting thing due to things like accrued expenses, but it is still something to note. Finally, the Aspiriant Risk Managed Equity Allocation Fund. This is their biggest fund with over $1.4 billion in net assets. Wow, over $1.4 billion. Their portfolio turnover rate is 11%, a bit more active than some of the others, but still not exactly a whirlwind. Their top holding here is the GMO Quality Fund at a staggering 33.5%. That is a huge concentration in one underlying fund. For comparison, a typical diversified equity fund would rarely have over 5% in a single holding. This tells me they are relying very heavily on this particular investment manager's strategy for a big chunk of their equity allocation. Then we have Reef Strategic Partners Fund at 7.4%. This is a private fund, meaning it's not publicly traded and likely less liquid. This section is important. It highlights that their private funds are typically private deals, are often hard to sell quickly and have restrictions on resale. Over 11% of this fund and over $112 million are tied up in these less liquid investments. This could be a problem if they need to raise a lot of cash fast. Now, something a little administrative but important. On the 18th of November 2025, they announced a change in their independent auditors. Deloitte, FIAMP, Touch LLP is out, and Tate, Weller, Sufty, AMP, Baker LLP is in. They say it is not due to any disagreements, which is good. But changing auditors can sometimes signal shifts in how a company wants its books to be reviewed. Let's look at the financials for the taxable bond fund. For the 6 months ending the 30th of September 2025, they reported a net realized loss of over $136,000. Not a huge number given the fund size, but it is a loss. However, they also saw an unrealized gain of over $4.7 million. So while they were down on realized gains, the investments they still hold made up for it on paper. Their total expenses before any waivers are about 0.5% of their average assets. That is pretty standard for a bond fund. Looking at net investment income, it is 0.20 per S-share. This means for every share, they are making about 20 cents from interest and dividends. And the total return for the period is a positive 3.86%. Not bad for a bond fund, especially considering the market conditions we've seen. Now, the municipal bond fund, this one had almost $24 million in net realized gains. That is a good sign, meaning they sold some bonds for more than they paid. But their unrealized gain is much smaller, just 0.05 per S-share. So the big gains are coming from selling things, not from the current value of what they hold. Expenses are slightly lower here, around 0.46%, very competitive. Net investment income is 0.14 per S-share. This means they are earning about 14 cents per S-share from interest. Their total return is 2.09% for the 6-month period. It's positive, but not as high as the taxable bond fund. Let's look at the defensive allocation fund. Its total return for the period was a strong 8.92%. That's a fantastic return, especially for a fund labeled defensive. Almost all of that came from realized and unrealized gains of 0.95 per S-share. They are making money on their investments. Expenses here are lower at 0.28%. This is quite efficient for a fund with such a high return. But check this out. Their net investment income is only 0.02 per S-share. This indicates the vast majority of their return is coming from investment growth, not from steady income. And finally, the Aspiriant Risk Managed Equity Allocation Fund. This fund is crushing it with a total return of 10.93% for the period. That amazing return is driven by realized and unrealized gains of 1.67 per S-share. They've clearly benefited from a strong market or well-chosen investments. Their expenses are at 0.42%, which is reasonable for an equity fund, and they've waived some of that to keep costs down for investors. Just like the defensive fund, their net investment income is very low at 0.05 per share. This suggests their strategy relies heavily on capital appreciation rather than dividend income. This note about defaulted securities popped up in the municipal bond fund, and it is a critical reminder. It means some issuers within their municipal holdings are in trouble financially. While the report doesn't give us the exact amount of exposure, understanding this risk is key to judging the fund's safety despite its tax-advantaged appeal. Then we saw liabilities exceeding assets by 0.1% in the defensive allocation fund's statement of assets and liabilities. Normally this is just a minor accounting blip, but seeing it paired with an extremely low net investment income and a very high total return, it makes you wonder a little about the structure and how they are managing their cash flow. Looking at the taxable bond fund's investments, about $248 million are in open-end mutual funds classified as core diversified. Stable holdings seem to be the theme here. But then you see private funds in the municipal bond fund with over $127 million, and the notes tell us these can be illiquid, meaning they are hard to sell quickly. This fund is managing over $1 billion, so 10% in illiquid investments might be worth watching if market conditions shift. Similarly, in the equity allocation fund, over $156 million are in private funds, also described as illiquid. This is over 11% of the fund's assets. While private investments can offer unique opportunities, this level of concentration in hard-to-sell assets carries significant risk. The change in auditors from Deloitte to Tate-Weller 30 AMP Baker is noted. They assure us it is not due to disagreements, which is standard language, but switching auditors, especially in the financial industry, can sometimes highlight a desire for a fresh perspective or a review of practices. The fact that it happened in November after the reporting period of September means it is a recent development they are disclosing. So, what is the story here? Aspiriant Trust manages a diverse set of funds, from bond funds to allocation and equity strategies. The taxable bond and defensive allocation funds are seeing solid positive returns, largely driven by investment gains rather than steady income, with the defensive fund actually posting eye-popping returns given its label. The municipal bond fund had a decent showing. But the mention of defaulted securities in the footnotes is a point of caution. The equity allocation fund, their largest, is performing very well with strong gains, but its heavy reliance on a single underlying fund and significant investments in illiquid private funds are notable risks. The overall approach across many of these funds appears to be a long-term buy and hold strategy given the 0% turnover in some funds, which is a valid approach, but can leave them less agile in fast-moving markets. The auditor change also adds a small element of curiosity about what might be on the horizon. Looking at the numbers, Aspiriant seems to be successfully navigating the market. Especially with their equity and defensive funds, strengths are clearly in generating capital appreciation. However, the concentration in specific underlying funds and the notable allocation to illiquid private investments in both the defensive and equity funds present risks that are worth monitoring. These private investments could be a double-edged sword, offering growth but also posing liquidity challenges. What is your take on these funds and their strategies? Do you prefer steady income, or are you chasing those capital appreciation gains? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up. And subscribe for more deep dives into corporate filings, and don't forget to join our community on Discord for more in-depth discussions. The link is in the description. Thanks for watching, and I'll see you in the next one.